Cool. Good morning, everybody, to our autumn 2018 quarterly commentary briefing. You may not have been aware, but this morning marks a little bit of history for the ESRI, in that the autumn commentary is the 50th anniversary of the commentary produced here by the ESRI. So we've been, for 50 years, we've been doing the definitive analysis of the Irish economy on a quarterly basis. So it's a little bit of history from our side. So to the back to the present, we're going to use the standard format. I'm going to talk through some of the forecast summary and contextualize where the domestic environment sits within that context. Then briefly talk about the monetary financial overview, where we're at present, and the housing market. At that point, I'll hand over to Kieran. He'll talk through the public finances, the external environment, and wrap up. Okay, so since our commentary in June, we have upped our GDP growth rate for 2018 quite considerably, from about 4.5% to 8.9%. Now, before we all fall off our chairs as to why we've made that particular revision, I'll go into it in a little bit more detail, but a very large proportion of that is due to the activities of multinationals, in particular the relative change in the trade balance that has occurred due to a reduction in imports of intellectual capital services. So I'll talk a little bit in detail about that. We do see the domestic economy growing a little bit more rapidly, but a large majority of the revision upwards is just to reflect the fact that in the actual accounts that we've got for the year to date, there are these changes in imports and exports that give a big boost to growth. We then come down substantially in 2019 to a headline GDP growth rate of 4.5%, which is much more in line with our expectations around the domestic economy. Normally, when we're we're trying to forecast out what's happening, we really look at the domestic underlying economy, when we don't have information like the quarterly national accounts that have just come out to give us an insight into how that particular year is progressing. So the 4.5 is much more based on our assessment of fundamentals in the Irish economy. Again, one of the hallmarks of the recovery and the strong growth we're experiencing at present is the developments in the labour market. We see substantial growth in employment this year, up about 3%. To about just over 2.2 million people in employment this year, and up by 100,000 next year approximately, with an unemployment rate to average about 5.7% for the full year of 2018. On the back of the strong growth in the domestic economy, the public finances have improved again this year relative to last year. We see a small deficit this year, turning into a very small surplus next year, but in general, what better is described as a balanced position next year. With our debt to GDP ratio coming back down, to 60% next year. Notwithstanding the fact that the GDP denominator here isn't a good measure of activity, and Kieran will talk a little bit about that in terms of the debt sustainability later in the presentation. Okay, so let me talk you through the summary forecasts, and particular point out the two different forces that are at play, which we have used to revise our overall forecast path for 2018. So with the recent data we've seen, in particular the consumption numbers and the retail sales numbers, we see consumer spending having risen into the second half of 2018. In particular, there was very strong consumption numbers in quarter two of 2018, up 2.8% on the quarter, and nearly 4% year on year. So the domestic economy is definitely rising with the improvements in the labour market and increased household incomes. We've also upped a little bit our government expenditure on the back of the more recent data on the spending profile. But despite the fact that the domestic economy is growing quite rapidly, much of the augmentation in the growth rate that we've taken on board for this particular quarter is due to the impact of the multinationals. So what we've seen quite recently is that there has been a big fall in imports, okay, in particular the importation of R&D related technology, and obviously there's been an offsetting fall in investment, because what was happening is these companies were importing this technology. It would become an asset here, so investment would go up, and they would kind of neutralize themselves a little bit. But that hasn't happened now, because what we have is companies using those assets that are now held onshore here in Ireland to produce exports elsewhere. Those exports are booked here in Ireland, and you have a big increase in exports and a fall in imports, which widens the trade balance and gives a big boost to the headline GDP figure. So you can see we're forecasting 8.9% growth in GDP this year. So the kind of two summary points to take away from this is, one, we have raised our forecast for this particular quarter. That is due to some increase in the domestic economy. We do see activity picking up domestically, but also it is very much dependent on activities of individual companies in the multinational sector, which are changing the trade balance and boosting the overall growth figures. When you move then into 2019, we still see strong growth domestically. We're moderating it slightly in terms of consumption. We're looking forward a little bit on the investment and trying to abstract from the multinational activity and make our forward-looking assessment more based on trends in domestic investment activity, so mirroring the modified investment series that the CSO produces. And so for next year, with the construction pickup, we're forecasting strong investment growth next year, and then a return to a more normalized trade activity with an increase in imports as well as increasing exports, which brings our overall growth rate down to 4.5%, which is only up marginally on our forecast for 2019 that we produced in June. Okay, so this just kind of depicts in a little bit more clarity why we've come to this particular assessment. So if you think about the domestic economy contribution to the growth, our assessment is based on two particular figures. So you can see here, this is real private consumption growth, this chart here, and quite interestingly, in the 2 quarters into 2018, this basically takes a 4-quarter rolling average. You can see there's really been a change in the trend here. So there's much stronger consumption growth than there was for the period in 2017. So we are seeing the domestic economy in particular, with household spending increasing quite rapidly in the last couple of quarters. So that is leading us to revise upwards our assessment of domestic activity. Similarly, for the modified investment activity, so this abstracts from investment in aircraft leasing and investment in the R&D related intangibles. And you can see again, while that slowed through 2017, it's picked back up in 2018. So both of these factors are leading us to raise our 2018 full year forecasts and our assessment into 2019. Then the final chart on the slide shows the change in the trade balance, basically, and as the effects I've described here, with the exports continuing to increase while the imports have fallen, which widens the trade balances, increases GDP growth. So two countervailing forces at play in the Irish economy at present. Okay, so just a little bit more on the personal consumption. What we've seen is quite a marked pickup into Q2 of this year. We're seeing annualized growth rates of over 4% for the second quarter of 2018, which is very strong. And when you look at the corresponding retail sales figures, that comes through quite clearly. In particular, you can see strong growth in household equipment, which is very likely tied in with the pickup of activity in the housing market and the increase in activity there. So certainly households benefiting from an improved labour market, real incomes rising modestly, and this is kicking in through to higher household spending on goods and services. Okay, as I've mentioned with investment, it's very complex. to try and understand what's happening on investment in Ireland using the overall CSO data. As you can see, we note that the intangible asset investment has been falling for 6 quarters, and that ties into the multinational activity that I was mentioning earlier. Our main story is really built around, when we're thinking about domestic investment, is what's happening with building and construction. And you can see it's increasing both in the share of overall modified investment that's contributed from building and construction, but also the line items, in particular dwellings and other building and construction, are up strongly this year. So certainly we can see a very tangible pickup in activity in the construction sector. Although it's coming from a low base, there certainly is a strong pickup in investment in construction in this year. On the back of that, we are forecasting about 18,500 housing completions this year, and up to about 25,000 next year. So a strong pickup in housing completions activity. One point to note, which you may have seen from the releases, is that as a special article to the commentary, we've released a paper which looks at SME investment patterns in Ireland. And part of the reason why we did this was to try and help build up our understanding of what was happening with the domestic firms, because the national accounts provide a picture which the multinationals distort to a certain extent. So you can see the survey we've produced highlights the very varied and diverse pattern of investment across SMEs, with in particular noting that many of them are happy with their investment, about 1 in 5 indicating that they have a capital gap, and many of them indicating they have considerable liquidity on their balance sheet, which suggests that they do have capacity themselves to increase investment if they so wish. So certainly the domestic firms themselves do appear to have, many of them are happy with their investment activity, and do have the resources to increase that if they so wished. Okay, so let me talk a little bit about the labour market. As I said, it has really been one of the hallmarks of the recovery. The unemployment rate dipped to 5.6% in August, and we see for the full year 2018 that coming in at about 5.7%, dropping then to about 5.1% for the full year next year. But if you look at the profile within the year, it's dipping below the 5 towards the end of next year. So certainly a very robust performance in the labour market. Employment is up about 2.9% this year. We're forecasting that will be the outlook for 2018. Slowing slightly next year, but still quite a strong increase overall. The question then ties into what's happening with earnings and what's happening to household incomes in response to this improved labour market performance. And you can see from the data more recently there has been a pickup in earnings. And the big question here is whether, as the unemployment rate drops down to what we would think of as maybe a full employment situation, do we see pressure starting to build in terms of the earnings side in the labour market? And you do see some pickup of more recently in terms of wages. On the back of the low inflation environment that we're experiencing at present, again with the falling unemployment, this suggests that we further real wage growth both this year and next year, which, as I've mentioned earlier, should be supportive for continued increases in household spending and consumption. Okay, so let me talk a little bit about the monetary and financial situation. As we've noted for a number of quarterlies, the mortgage market is increasing rapidly. It's up nearly 17% in volume terms in the year to Q2 2018, and up even more in value terms. Obviously, the new mortgage lending that's going out now is governed by the macroprudential regulations, and the type of loans that are going out now look much safer than they were in the past, which is a very important from a credit risk perspective and in understanding the vulnerabilities in the market. But again, there is quite a large increase in lending activity in the mortgage market. We're also observing quite a stark increase in SME lending, in particular towards those sectors that are domestically oriented and non-traded in nature. For example, the construction sector, real estate, hotels and restaurants. These sectors are taking more and more of the increase in SME lending, and that makes sense given their growth path and the fact that they're ramping up to deal with aspects such as the housing crisis. But certainly given the pace of acceleration in these areas, it's something that requires careful monitoring. For the past number of quarterlies, we've kind of delved in detail a little bit on the housing market, in particular the loan-to-value ratios and the loan-to-income ratios, to try and get an understanding of the financial stability aspects in the market. What we've done this time around is to try and take a little bit of a broader view using new data that have been published by the Bank for International Settlements in relation to how the Irish economy is funded. Okay, so how is the bank lending funded? And what this chart shows is the outstanding stock of lending to the Irish economy by the residents of who have provided that financing. Okay, so basically, as this goes up, there's more lending coming from foreign sources into the Irish economy through the banking sector. And what you can clearly see here is that the vulnerabilities built up in terms of the banking sector stability, basically by borrowing very large amounts on the wholesale money market through European counterparty lenders. And that has really mitigated and fallen off quite considerably. So you can see the red line picks up the cross-border lending as a share of GDP, and we're back towards the kind of pre-boom levels, which is, in our assessment, much more a stable position for the banking sector to be in. It's quite interesting when you look at the detail between all the various sources of lending. More recently, you can see an increase in the Japanese or the US component, and this is related to multinationals in particular, whereas the vulnerabilities built up before coming through Irish banks borrowing from their European counterparts to fund the mortgage market, and that certainly is not a feature of the current lending activity in the Irish economy.
So, I mean, again, this kind of, I suppose, falls out from some of the monetary and financial statistics in terms of the fact that the large increase in lending that we're observing is increasingly related to activity in the mortgage market. So you can see the value of mortgage drawdowns up 22% year on year for Q2 of this year. As Conor said, our forecast for completions in 2018 is up to 18,500, and already this year you've seen completions increase by some 34% year on year for Q2. Of course, we're also witnessing continued upward pressure on prices. So prices up 10% nationally in July. Although what we are seeing, and we commented on this in a previous commentary, is that the rate of inflation, house price inflation in Dublin, seems to be easing off and modifying. And I think whilst there's no definitive evidence of this, I think it's fair to say that the presence of the macro-prudential regulations are very important in that regard. In that they're essentially constraining, if you like, house price inflation because they make sure that households are only able to borrow a certain multiple of their income. This trend, if you like, or this kind of stylized fact in the Dublin market is something that's actually been commented on in the London market. Recently we were at a conference early on this summer and the same observation was made that house price inflation in London appeared to be moderating, again because of the presence of the macro-prudential regulations. Of course, we also see rents are still climbing, quite strongly, up 8% in Dublin, 6% outside Dublin. And while we are witnessing an increase in supply levels, there's no doubt that the overall level is still below the structural demand in the economy. And as long as actual supply is below that structural demand, then there will be continued upward pressure on prices and rents over the next couple of years. Early on this summer, we published some work from the research program that we have with the Department of Housing, and we've commented on some of that work in the commentary in relation to the housing market and trends, the apparent trends in the market. So, for instance, we did quite a lot of work looking at affordability issues. We looked right across the market over quite a long period of time to look at different trends in affordability in terms of housing costs. So both in terms of mortgage repayments and in terms of rental repayments, to see who are the people who are struggling the most, if you like, or who had the highest burden of housing costs. In general, it's quite a large piece of work, but the one or two kind of summary points that we would glean from it is that it's essentially low-income urban households which are renting, particularly in the Dublin area, renting privately, who are the ones with the highest burden of housing costs to their overall disposable income. And obviously for these households who would be in other circumstances looking, if you like, to move into the home ownership market, it's increasingly difficult for those households given the amount of income that they're paying every month on rent. I updated some earlier work that I had done looking at house prices in terms of seeing whether we think house prices are still moving on a sustainable basis. And what we concluded is that we still feel the market is, if you like, in broadly speaking across the market nationally, we think the market is in equilibrium, broadly speaking. We think that house price levels are justified or are explained by the state of fundamentals in the economy at this point in time. So in terms of things like income levels, unemployment, demographics, etc. But we see, because we see the economy doing quite well over the next couple of years, because we see income levels growing, we see unemployment likely to remain low, we still think that monetary policy is going to be somewhat accommodative. So therefore we see that housing demand is going to continue to increase over the coming years. And with housing supply still quite fixed, that means that you're going to see continued upward pressure on prices and rents. And this will, unfortunately, continue to exacerbate the affordability issues that are already in the market. The conclusion from the work, in particular the first piece of work, I suppose, was to state that any policies that increase housing supply are critical, in particular as far as social and affordable housing, where there's obviously been, we are playing catch up, I suppose, after a period of disinvestment, and this is the strong case for public capital investment in this area, and I'll touch on that in terms of our overall assessment of the public finances and the budgetary strategy. So as far as the public finances are concerned, we see again strong tax receipt growth into 2018. In the year to August, we see tax revenues overall up by 5%. Within that, we see corporation taxes up over 10.5%, income tax growth, VAT is up, excise duty is down. The one figure we haven't put up there is PRSI growth, PRSI related receipts, which are very closely tied in with the labour market. They're registering very particularly strong growth this year for the year to August. So overall then we think we're still, the budgetary policy is still likely to register a deficit in 2018. Next year we think there's a possibility certainly of a balanced budget and maybe even the possibility of a very mild surplus. And we think that public debt is set to fall from down to 64% of GDP down to 60% I think next year. But as Conor said at the outset, a more appropriate comparator really as far as the output denominator is concerned is to look at GNI star for the variety of reasons that have been discussed as far as the fact that it's more appropriate at capturing underlying activity levels in the Irish economy. When you look at GNI star, you see that the public debt level is still over 100 even by the end of 2019. So even with very strong growth this year and next year, you still see public debt as a percentage of GNI star above 100%, and that is very high. Even for an economy which has been performing quite well over the last number of years. That all leads us to our assessment of the public finances, I suppose, and in terms of the upcoming budgetary strategy, what is the appropriate strategy? Using GNI, as I said, the Irish debt remains high. Under what we call normal circumstances, in inverted commas, we believe a contractionary budget would be advisory in the sense of trying to target surpluses as a way of building up financial buffers for when times are not as good as they presently are. However, for two reasons we don't advise or don't suggest that explicitly contractionary budgetary policy should be pursued at present. Those two reasons are A, the infrastructural deficits, in particular in housing, and as I said earlier, we believe there is a strong case to maintain the capital investment, increase capital investment in the housing area, particularly to generate social and affordable housing. And so we believe that you shouldn't scale back the budget in that area, scale back the expenditure in that area as a result. The other reason why we think a contractionary budget, we wouldn't advise a contractionary budget at this point in time, is the possibility of a no-deal Brexit next year instead of a no-Brexit deal as we have up there. A no-deal Brexit, as we know from the mood music, unfortunately, Certainly the possibility of a no-deal Brexit appears to be increasing. Now, we'll see how things go over the next month or so in terms of the big summit, etc. But certainly the mood music isn't very positive as far as a successful Brexit deal is concerned. If you were to implement a contractionary budget, so if you were to try and take more money out of the economy than you're putting in, the danger is that if we have a very adverse shock under Brexit, a no-deal Brexit early next year, that you could merely compound the shock that the economy would suffer. And I think in reality, whilst we've done a lot of work in the Institute looking at Brexit and its potential implications for the Irish economy under various different scenarios, a no-deal Brexit in particular is very, very difficult to evaluate. The actual implications for the Irish economy are very difficult to evaluate. The downside risk is very, very hard to quantify. And so if you have a contractionary budget, an explicit contractionary budget, compounding that, it could have quite an adverse impact. So overall then our assessment, and again it's quite a complex situation, it's not a very clear cut, but we believe at present probably the most optimal policy is a neutral budgetary policy. Even with that neutral budgetary policy, we still think there is a possibility of a mild surplus next year. So there is still the possibility of a mild surplus in 2019 under a neutral budget. But that's our overall assessment as far as that's concerned. On the external environmental front, it's clear that whilst the trade balance is making a significant contribution to growth this year, as Conor has outlined at the start, a lot of that is because of multinational related activities. Those activities, as we know, are highly volatile, so suddenly you can go from a situation where your imports are falling to a situation where imports are growing quite strongly, or your exports start to fall vis-a-vis where they are now, where they're growing quite strongly. So that contribution is somewhat volatile. This year and next year, or certainly next year, obviously we see very significant risks as far as the external environment is concerned. Obviously Brexit and the possibility of a no-deal Brexit early next year, but also US trade policy. And we talk about this issue quite a bit in the commentary in terms of the scale of tariffs that are now coming into play and the tariffs that have been brought in to date. And there is a long-standing result in terms of a lot of modelling work that we've been doing here in the Institute over the past 20 or 30 years. A very robust result which suggests that if there's a 1% decline in global GDP, that usually translates into a 1% decline in Irish output, Irish economic activity. So clearly, the more tariffs we have and the more disruption we have in trade between the US and China, the more negative impact that has on global economic activity, and consequently, that does feed through into the domestic economy. I should say just before we conclude that all of the forecasts that we have made for next year, we are assuming our technical kind of assumption underpinning that is that there is a form of agreement between the UK and the EU along the lines of the kind of the EEA, European Economic Agreement, that the EU has with other countries. So that's basically our technical or our working assumption as far as our forecasts are concerned. Clearly, if there's a no-deal Brexit, then that assumption no longer holds. So overall, our assessment is that, as Conor said, we see economic activity still increasing significantly. Certainly, so far this year, consumption and modified investment have grown stronger than what we would have expected, certainly at the start of the year. Multinational related activity is impacting the balance of trade, so our imports are very, very low relative to where you would expect them to be for an economy that's growing quite strongly. We do see global risks particularly elevated next year, obviously Brexit, but also the trade situation. And overall, as far as the public finances are concerned, we think a neutral budgetary policy is on balance the most advisable course of action for the forthcoming year. With that, we see a deficit this year and the possibility of a minor surplus or certainly a balanced budget in 2019.